Welcome to vTalkInsight, Market Drivers Daily for March 26, 2026, where an accelerating oil shock is colliding with fragile risk appetite across equities and credit. Geopolitics, energy prices, and supply chains are now pulling in the same direction. So let us begin in the Middle East, where conflict dynamics are increasingly setting the terms for every other asset class. Geopolitical risk has moved from background noise to the main driver of the macro narrative, with the Iran conflict and Middle East tensions now anchored in energy markets. Oil is trading well above $100 as disruptions around the Strait of Hormuz crystallize into an energy crisis rather than a brief supply scare, forcing equities, rates, and currencies to reprice around this new reality. Recent United States airstrikes on Iran triggered another spike in crude and a sharp equity sell-off, underlining how sensitive markets are to any hint of escalation. Tanker traffic through the Strait of Hormuz has collapsed from more than 100 ships a day to fewer than 10, and Iran is pushing maximalist demands, from sovereignty over the strait and war reparations to formal transit tolls that have reportedly reached $2 million on a single vessel. Diplomatic channels are active but fragmented, which keeps the range of outcomes unusually wide. The United States has paused further strikes for 10 days, citing progress in talks mediated by Pakistan. G7 foreign ministers are stressing de-escalation, and Canada has tightened sanctions. Yet Iran publicly rejects key proposals, and Gulf states signal readiness to support U.S. operations if needed. That geopolitical stalemate is feeding directly into inflation, growth, and policy expectations. Scenario work points to crude prices in the $120 to $160 range if energy supply disruptions persist or infrastructure is hit, with several analyses flagging $150 as the point where a global recession becomes much more likely. Forecasts for G20 inflation have already been revised up by roughly 1 to 2 percentage points on the back of these energy shocks, and the OECD now projects United States inflation around 4.2% this year. Markets have shifted from expecting Federal Reserve rate cuts to pricing no cuts at all, while expectations for extra Bank of England hikes are seen as overdone unless oil surges decisively above $150 and stays there. Because of this, regional and asset class divergences are becoming clearer. The United States, as a net energy exporter, is viewed as relatively insulated compared with Europe and Asia, where higher gas and oil costs threaten competitiveness, and energy importing emerging markets face weaker currencies, squeezed real incomes, and a rising risk of consumer-led downturns. Traditional safe havens are not behaving as they used to, which complicates defensive positioning. Gold is under pressure from a stronger dollar and higher yields. Some even see further downside risk if central banks sell reserves to fund fiscal needs, while U.S. Treasuries are delivering less diversification as term premia rise on persistent geopolitical and supply uncertainty. Flows reflect a cautious but not yet capitulatory stance. Investors are trimming risk across rates, equities, and credit, raising cash and favoring select commodities, while U.S. equities and the dollar are being treated as relative safe havens even as emerging market currencies sell off and energy-importing countries struggle with margin compression and consumer stress. At the same time, there is a credible resilience story limiting outright panic. United States jobless claims remain low. Consumer momentum is helping absorb higher gasoline prices. Several investment committees still do not see the hallmarks of a major downturn, and some scenario work suggests the S&P could recover towards 7,150 by year-end if disruptions ease and the Strait of Hormuz reopens. For now, though, markets may be underestimating the odds that conflict and energy disruptions drag on. The critical watch points are the approaching negotiation deadlines. Any sign that Hormuz shifts from temporary closure to a permanent toll regime, potential G7 action on energy and fertilizer supplies, and domestic United States political pressure as gasoline prices push above $4 a gallon. Against that geopolitical backdrop, volatility is no longer a shock. it is becoming the baseline. Market conditions are described as extremely uncertain, with rapid swings between optimism and pessimism now routine, and many firms shifting away from point forecasts toward contingency planning as the dominant mindset. Equity markets are reflecting this two-sided risk. S&P 500 NASDAQ futures are down around 0.6 to 0.7%. European indices like the Stoxx 600 and the DAX are posting broad-based declines, and in one session, more than 450 of 600 stocks members traded lower, even as energy names eked out gains on higher crude. The relationship between oil and equities has flipped into a highly negative regime, with one of the largest monthly oil surges in more than 3 decades driving repeated risk-off episodes in stocks. Yet, interestingly, United States equity ETF flows have been positive since the conflict began, which suggests technical and systematic strategies are still supporting indices even as discretionary risk appetite fades, particularly into weekends. Traditional volatility shock absorbers are less reliable in this environment. Gold and U.S. Treasuries have not delivered the classic safe haven response, as rising energy and inflation risks push bond yields higher across the curve and structurally raise term premia, eroding the diversification benefits that many portfolios have long relied upon. The stress is visible in credit and private markets as well. Higher rates and rising defaults have already been pressuring credit spreads. A large private credit fund has posted record losses and imposed withdrawal caps, and listed insurers with sizable private credit exposure have traded lower, all feeding expectations of further consolidation as both strong and weak players are absorbed. Technology and AI-exposed assets are another focal point for volatility. Recent swings in software stocks linked to AI disruption look to have been an overreaction because not all business models are equally vulnerable, yet retail investors have started selling high-growth names like NVIDIA for the first time in months, signaling a shift in sentiment, even as many companies can still harness AI for competitive gain. Overall positioning points to caution rather than capitulation. Market participants are reducing exposure across interest rates, equities, and credit, cutting trade sizes, relying more on derivatives, and gravitating toward defensive sectors such as real estate, staples, and materials, while others raise cash and selectively add commodities and stockpile-able assets as hedges against inflation shocks. There is a tension between warnings of complacency and evidence of resilience. On one side, major asset managers and policymakers argue that markets underprice scenarios where oil spikes toward $150 or even $200 and pushes the S&P down toward 6,000 or below. On the other, strong earnings, a still solid labor market, and functioning liquidity suggest volatility remains elevated but not disorderly. For sophisticated portfolios, this points to a regime of wide outcome dispersion rather than a single base case. Key indicators to watch include changes in option skew and implied volatility around geopolitical deadlines, flows into and out of equity and credit ETFs, evidence of further strain in daily liquidity private vehicles, and whether weekend headlines repeatedly reset risk appetite as energy and conflict news evolve. Beyond the price of oil itself, the conflict is reconfiguring global supply chains in ways that look increasingly structural. The closure and partial militarization of the Strait of Hormuz have halted much international shipping through a key choke point, with tanker traffic dropping from over 100 vessels a day to fewer than 10, and at least one ship reportedly paying a $2 million transit fee. Those constraints are rippling quickly through the real economy. Blocked straits are limiting exports, forcing refinery shutdowns and feedstock shortages, pushing Brent above $105 and triggering sharp increases in jet fuel crack spreads that airlines say will mean higher ticket prices and travel-related inflation into the summer. Energy is only part of the story. Critical inputs from fertilizers to industrial gases are also affected. Clients are reporting canceled orders and shipping challenges for oil, fertilizer, and semiconductors, LNG disruptions in Qatar threaten about 70% of its gas capacity for years, and helium shortages are creating new bottlenecks for chip production, particularly in Asia. Corporate earnings guidance is being clouded by these cost and logistics shocks. Hapag-Lloyd expects roughly €50 million a week in extra expenses from Middle East disruptions. UK apparel retailers are warning on margins as consumer confidence hits new lows, and surveys show British firms bracing for higher taxes, energy, labor, and financing costs to squeeze profits and lift prices, with some retailers planning around 5% price rises in the autumn. At the macro level, this adds up to a more stagflationary backdrop, extending through 2026. Persistent supply shocks in oil, LNG, fertilizer, and shipping have led international bodies to raise global inflation forecasts by about 1.2 percentage points, while warning that further disruption to Middle East exports could force a sharp repricing of financial assets and materially increase the risk of a hard landing. Strategically, supply resilience is accelerating deglobalization trends. Countries are prioritizing domestic or allied supply, redirecting physical oil demand from Asia toward the Gulf Coast and Atlantic Basin, and exploring coordinated G7 actions, from deploying strategic petroleum and fertilizer reserves to rethinking exposure to critical choke points, even as China uses the turmoil to pitch itself as a more stable long-term partner. This environment is reshaping sector winners and losers. Energy producers and some real assets have outperformed and acted as portfolio diversifiers, while manufacturers face margin compression from rising energy and transport costs. Airlines, chemicals, agriculture, and semiconductors grapple with volatile inputs, and shipping and logistics companies see earnings downgrades despite elevated freight rates. Even high-growth themes like AI and defense are not immune to these constraints. Rapid AI adoption risks overwhelming data center, power, and regulatory infrastructure, creating near-term vulnerabilities, while in defense the United States currently lags in production of small, inexpensive drones compared with conflict zones like Russia and Ukraine, highlighting fragilities in its own military supply chains despite leadership in advanced unmanned systems. Looking ahead, the balance between disruption and adaptation will be crucial. Watch tanker flows and fee regimes through Hormuz, updates on Qatar LNG and semiconductor gas supplies, any concrete G7 moves on strategic reserves, and how corporate earnings season frames energy and logistics costs, because those signals will indicate whether today's supply shock stays a drag on margins or begins to fade as new routes and contracts bed in. To sum up, geopolitical tension around Iran and the Strait of Hormuz has pushed energy to the center of the macro story, with oil scenarios up toward $150, creating real downside risk for growth and forcing investors to rethink regional and sector exposures. Volatility is becoming a standing feature rather than a surprise, exposing weak points in credit and private markets, while traditional safe havens offer less protection and real assets take on a bigger ballast role. And persistent disruptions across energy, shipping, and critical inputs are entrenching a more stagflationary, deglobalizing landscape that will shape earnings, inflation paths, and asset correlations well beyond the current headlines. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.